Why is Goldman down? They made a lot of money. Okay, they sold off some of their long-term assets. But why are they down?
Well, Stuart, they're not a depositor institution in the way that JP Morgan and Bank of America are. Mm-hmm. So they can't take large lumps of their deposit, park it at the Fed, and expand their net interest rate margin by paying 0% to their depositors and getting 4.75% from the Federal Reserve, which has padded the bottom lines of all the major money center banks.
So, does the Goldman's decline down 3.5%, having sold off some of their long-term assets, does that mean that the banking crisis is still with us?
You know, Stuart, it's really hard to figure out where this next banking crisis and how it's going to play out. So I would say Silicon Valley Bank is your first liquidity event. The next thing that comes is a credit event. And I believe this will be somewhere in commercial real estate. Office occupancy in New York City is at 44% now, down from above 90. Okay, I don't think that's ever going to get back up there. So think about all the tertiary markets in all of the blue states where the lockdowns were draconian and people have never gone back to the office. Well, a lot of these commercial real estate loans are from small and mid-sized banks, and it's really hard to put your finger on that and what kind of blow-up we're looking at, because a lot of these places have 5, 10, 20-year leases that will be coming due over the next few years. And if your office is unoccupied, why are you going to renew your lease?
Fair point. Fair point. Okay, outside office leasing problems and commercial real estate and bank problems, outside of that, the rest of the market is up. Seems like it still wants to go up. The rest of the market, that is.
Yeah, look, I think this is borderline insanity. I think most market sentiment is with me on that, which is probably why you're going up. I'll be clear, I am not short the market. I am just underweight equities, and I am overweight defensives in the equities that I still have. But if you look at this from a pure valuation standpoint, okay, we're at about a 20 PE ratio over 20 going forward. So if you flip that PE ratio over, you get the earnings yield. So you have a 5% earnings yield. Well, in 2019, we were at similar valuations. But in 2019, you had an expanding Fed balance sheet, you had rates getting cut, and you had a growing economy. Okay, right now, short-term interest rates are not zero like they were in 2019. They're at almost 5%. The 10-year Treasury is not at 2.5; it's at 3.6. So I think earnings estimates are way too high going forward. Every time we've had a collapse in manufacturing and housing and minor banking crisis like we've seen so far, you've gone into a recession. And so, you know, markets can remain irrational far longer than you can remain solvent. Stocks may soldier through, but I am not bullish.
Okay, but that's what I'm looking for. Mike Lee is not bullish. Okay, I'll leave it right there. Mike, thanks very much indeed. Let's turn to politics for a moment.